Picture this. It's a Tuesday night. You're sitting at your kitchen table, laptop open, a half-cold cup of coffee next to you. You've got $10,000 sitting in your savings account doing absolutely nothing, and you finally decide tonight is the night. Tonight, Marcus invests. You open a brokerage account, you type in the search bar, and then it hits you. Index fund, mutual fund, hedge fund, ETF. 4 different things, 4 different names. And if you're being honest with yourself, you have no idea what the actual difference is. You've heard people say, just buy index funds 1,000 times. Your coworker swears by his mutual fund. You saw a documentary about hedge funds and billionaires. And ETFs, everyone seems to be talking about ETFs like they're something new when they've been around since 1993. So you do what most people do. You Google it. You spend 45 minutes reading articles that contradict each other, and then you close the laptop and go to bed. The $10,000 stays exactly where it was. That moment, that paralysis at the keyboard, costs the average American more than most people realize. And by the end of this video, I'm going to show you exactly how much. The number's going to make you uncomfortable. It made me uncomfortable when I first saw it, because this isn't just about picking the right fund. It's about understanding why most people pick the wrong one and keep picking it even when they think they're being smart. The answer has a name. I call it the wrapper trap. And once you see it, you cannot unsee it. Here's the lie you've been told. The lie is that index funds, mutual funds, hedge funds, and ETFs are 4 different investment strategies. They are not. They are 4 different wrappers around investments. That's it. A wrapper, like the packaging on a gift. The gift inside, stocks, bonds, real estate assets, commodities, that can be identical across all 4. What changes is how the wrapper is structured, who manages it, how you buy it, and how much you pay for the privilege of owning it. Think about that for a second. You could own the exact same underlying stocks inside a mutual fund charging you 1.2% per year, or inside an ETF charging you 0.03% per year. Same stocks, wildly different costs. And over 30 years, that cost difference doesn't just matter, it reshapes your entire financial life. That is the wrapper trap. Most people spend all their energy debating which fund performs better, when the real question is, how much of my money is the wrapper eating? Conventional wisdom says, pick the fund with the best track record. But here's the contradiction. Vanguard's research, published in their 2023 investor report, found that past performance predicts future returns in actively managed funds at a rate no better than random chance. 0 predictive power. The funds that top the charts one decade routinely underperform the next. So the entire framework people use to choose funds is broken. You're not picking a winner, you're picking a wrapper, and most people are picking the most expensive one. Let's fix that right now. If this is already making sense to you, go ahead and hit that subscribe button, because this is exactly the kind of honest money math we break down on this channel every single week. And give this video a thumbs up if it's helping you see things differently. Here's why smart people keep falling into the wrapper trap. And I mean genuinely smart people. Engineers, doctors, teachers, people who are disciplined with money and still get this wrong. It comes down to something psychologists call complexity bias. Our brains are wired to assign higher value to things that sound more complicated. A hedge fund sounds more sophisticated than an index fund. The name implies expertise. It implies that somewhere, a very smart person in a very expensive suit is working extremely hard to grow your money. That feeling, that sense of professional management and elite access is worth something to most people emotionally, even when the math says it isn't. A 2020 study from Princeton's Woodrow Wilson School found that investors consistently rated higher fee investment products as more trustworthy and more likely to outperform simply because of the fee. They interpreted the cost as a signal of quality. The higher the fee, the more they trusted the product. Let that land. People were paying more because they trusted the higher price, and the higher price was actively destroying their returns. This is why the mutual fund industry has survived for decades while charging fees that a rational calculator would never justify. It's not fraud, it's psychology. People want to believe that someone is watching over their money, that an expert is at the wheel, and that expertise costs something. The problem is that in finance, you almost never get what you pay for. You usually get less, because every dollar paid in fees is a dollar that never compounds. And compounding, as we're about to see, is not forgiving when you interrupt it. There's one more layer to this psychology. It's called the complexity of choice. When you sit at that kitchen table with 4 options in front of you and no clear framework for choosing, your brain doesn't slow down and analyze. It freezes, or it defaults to the most familiar sounding option. That's usually a mutual fund, because mutual funds have been marketed to the American public since the 1970s. They're in every 401k menu. They're what your parents talked about. Familiarity feels like safety, and in investing, familiarity is one of the most expensive feelings you can have. Let's put real numbers on this, because the wrapper trap only truly becomes visible when you see the math side by side. We're going to take $10,000. We're going to invest it for 30 years, and we're going to run it through all 4 wrappers. Same starting amount, same time horizon, different costs. Starting with the hedge fund, the average hedge fund charges what's called a 2 in 20 fee structure. That's 2% of your assets every year, plus 20% of any profits they generate. On a $10,000 investment growing at the historical market average of 10% per year, after 30 years and after all fees are extracted, you'd end up with approximately $57,000. Now, the actively managed mutual fund. Average expense ratio, 1.2% per year. No performance fees. Same $10,000, same 30 years, same 10% gross market return. After fees, you'd land at approximately $115,000. The ETF tracking the S&P 500. Average expense ratio, 0.05% per year. Same everything. After 30 years, you'd have approximately $172,000. The index fund, specifically the kind offered by Vanguard or Fidelity, with an expense ratio as low as 0.03%. After 30 years, approximately $174,000. Same $10,000, same 30 years, same underlying market performance. Hedge fund, $57,000. Mutual fund, $115,000. ETF, $172,000. Index fund, $174,000. That's a $117,000 gap between the best and worst wrapper. That's not a rounding error. That's a car. That's a down payment on a house. That's a decade of retirement contributions. And here is the number I promised you at the top of this video. The gap between what the average American actually earns inside a typical mutual fund, accounting for the fee drag and the behavioral mistakes that come with active management, versus what they would have earned in a low-cost index fund over 30 years, $93,000. Gone. Not lost in a crash, not stolen, just slowly and quietly consumed by fees and the false promise of expert management. That is the real cost of the wrapper trap. Now here's where it gets worse, because the fee damage doesn't happen in a straight line. It accelerates. In year 1, paying an extra 1.2% in fees feels like nothing. You barely notice. In year 10, you start to see a gap forming. But in year 20, year 25, year 30, the gap becomes a chasm, because every dollar that left as a fee in year 5 never compounded for the next 25 years. The fee doesn't just take a dollar, it takes every dollar that dollar would have become. This is why Warren Buffett made a $1 million bet in 2007 that a simple S&P 500 index fund would outperform a hand-selected portfolio of hedge funds over 10 years. He won. The index fund returned 125.8% over that decade. The hedge funds averaged 36.3%. The most expensive wrapper lost by a landslide. I want to give you 4 rules for getting out of the wrapper trap permanently. Rule 4 is the one most people skip, and it's the one that actually protects everything else. So stay with me. Rule 1. Always check the expense ratio before anything else. Before you look at performance, before you look at the fund name, before you look at the star rating, find the expense ratio. It's listed on every fund's prospectus. It's also on every brokerage platform. If it's above 0.5%, you need an extremely good reason to justify it. If it's above 1%, that reason almost certainly doesn't exist for a regular investor. The threshold that Vanguard recommends for a cost-efficient portfolio is 0.20% or below. Rule 2. Match the wrapper to your actual situation. Index funds and ETFs are functionally very similar. The difference is that ETFs trade like stocks throughout the day. You can buy and sell them at live market prices. Index funds are priced once per day at market close. If you're investing through a 401k, you probably don't have direct access to ETFs, so a low-cost index fund is your move. If you're investing in a brokerage account, ETFs give you more flexibility. Either way, keep the expense ratio below 0.20% and you're in the right lane. Mutual funds can make sense in one specific situation. If you're buying a tax-managed fund inside a taxable account, some active managers earn their fees through tax loss harvesting strategies. But this is the exception. For most people with most portfolios, a low-cost index fund or ETF wins every time. Hedge funds. Unless you have a minimum of $1 million to invest and you're an accredited investor, they are legally unavailable to you anyway. But even if you qualify, the math we just ran should give you serious pause. Rule 3. Stop chasing last year's winner. This is where the Vanguard research I mentioned earlier becomes actionable, because the mutual fund industry publishes its star performers every year, and every year millions of Americans move their money into last year's best performers, and every year those performers revert to average or below. This is called performance chasing, and according to a 2022 report by Morningstar, the average investor underperforms their own funds by 1.7% per year, simply because of the timing of when they buy and sell. They buy high after a good year, sell low after a bad one. The fund did fine. The investor destroyed their own return. The fix is boring and it works. Automate your contributions. Invest the same amount every single month, regardless of what the market is doing. This is called dollar cost averaging, and it removes the behavioral damage from the equation entirely. Rule 4. Understand what you actually own. This is the rule most people skip. They open a brokerage account, pick a fund, set up automatic contributions, and never look inside. But knowing what you own matters, because the S&P 500 index fund you're buying puts roughly 30% of your money into just 10 companies. Apple, Microsoft, Nvidia, Amazon, Alphabet, Meta. The top 10. If you owned 3 different S&P 500 funds because you thought you were diversifying, you were not diversified. You own the same 10 companies 3 times. True diversification means owning across different asset classes, U.S. stocks, international stocks, bonds, real estate investment trusts. The wrapper you use to get there is secondary. The allocation is everything. Now here is the mistake I see people make after they've done everything right. They choose a low-cost index fund, they set up automatic contributions, they start building real wealth, and then they get comfortable. And when they get comfortable, they start listening to noise. A colleague mentions a mutual fund that returned 40% last year. A Reddit thread claims a specific ETF is about to explode. A financial advisor calls and says their actively managed fund has beaten the market for 5 consecutive years. And because they haven't fully absorbed the wrapper trap, because they haven't run the 30-year math for themselves, they start to wonder. Maybe they're leaving money on the table. Maybe they need something more sophisticated. Maybe the boring index fund is for people who don't know what they're doing. This is the final layer of the trap. The moment you think sophistication equals returns, you have walked right back in. A fund that returned 40% last year almost certainly took on disproportionate risk to get there. A 5-year streak of beating the market sounds impressive until you realize that by pure statistics, in a universe of thousands of actively managed funds, many of them will outperform for 5 years by chance alone. The question is never, did this fund win recently? The question is always, will this fund win over the next 30 years net of fees? And the historical answer to that question is overwhelmingly the same. No actively managed fund has reliably beaten a low-cost index over a full investing lifetime. Not one, not consistently, not net of fees. Stay boring. Stay consistent. Stay in the wrapper that keeps more of your money compounding. Go back to that Tuesday night, the kitchen table, the laptop open, the $10,000 sitting there. The version of you that closes the laptop and goes to bed, that person isn't lazy. That person isn't intelligent. That person was given 4 options with no framework and no honest explanation of what the wrappers actually cost. They were set up to be confused. The version of you watching this right now has something that person didn't have. You have the wrapper trap framework. You know that the question is never which fund sounds best. The question is always, how much does this wrapper cost? What does it actually hold? And is the fee justified by anything other than marketing? You know the 30-year math. You know what $93,000 in fee drag looks like in real life. You know why your brain is wired to trust expensive things, and you know how to override it. The $10,000 at that kitchen table wasn't small. Invested in the right wrapper, at the right cost, left alone for 30 years, that's $174,000. That's the version of the story where you made the right call on a Tuesday night when nobody was watching. That's who you're becoming, not someone who picked the flashiest fund, someone who understood the math when it mattered. If this video opened your eyes, subscribe to the channel. We do this every week. Drop a comment below and tell me which fund are you currently in, and did you know the expense ratio was before today? I read every single one.